Hey guys, Andy Tuttle here with the Tuttle Group. I hope you're doing well. I wanted to get out this video about some of the tax changes. I know there's some confusion out there and concern about the new tax bill, so I wanted to go over some of the highlights and, well, lowlights if you want to look at it that way. Mostly I'll focus on the housing changes. There's some other things in there, but hopefully this will be some good information for you to get back to your clients and help you understand it better. So a couple of things. One, this tax code that came out that the Republican lawmakers came out with last Friday, it does reconcile the House and Senate bills. Using an accountant right now, tax preparation, tax related expenses like software is no longer tax deductible. Most of the changes will take effect in 2018. They're going to last for 7 years. There are a ton of changes to go into, so I won't go into all of them. Again, I'll focus mostly on the housing changes. But the SALT, state and local tax, has been capped at $10,000. I know we don't have that here, but you have a lot of reload buyers, so that's why, or we're seeing a lot more of that. So I wanted to kind of make sure you understood it. So this will affect like places like New York and LA, really high dollar areas. Like the average SALT deduction in New York is $57,000. And property deduction is $14,000. Now both will be capped at $10,000. So that is a $61,000 haircut. The economists are already saying that could see prices decline in places like New York and LA as much as 10% because of that. So again, your reload buyers, tell them not to prepay their taxes or try to get ahead of this, paying their property and state and local income tax. It won't work. Their accountant's not going to allow it, and neither is the government. It's just not going to be allowed. The IRS isn't going to allow it. So currently as well, you can deduct interest you pay on up to $1 million in mortgage debt. The new changes are going to make that $750,000, and so also now you can have about $100,000 if you get a home equity loan or an equity loan of any kind, a line of credit. Then you can deduct $100,000 of the interest that you pay on that. But now you can't deduct any home equity loans. No interest deductions for home equity loans going forward. So that actually kind of hurts us on our side a little bit more. And some of the clients trying to get some cash to pay off debt is no longer tax deductible. So that's too bad. Also, if you do close before December 15th, so some of your buyers that already closed and they may be closed on some higher dollar homes and they're concerned about this, as long as it was before December 15th, they can still deduct the mortgage interest they pay up to $1 million. They will not be subject to the new $750. Another thing to look at is the standard deduction. This is kind of, I'm a little sad about this one because it's going to affect some incentive for home buying. So single filers right now, the standard deduction for those that don't itemize is $6,350. That's going up to $12,000, which is great, right, for people individually, but it's not great for housing. From on your joint, $12,700 currently. That's going up to $24,000, and so currently, if you don't itemize and you buy a house, you get that interest deduction, and that really helps you get a little bit more write-offs. But now with the standard deduction so huge, on those homes under $300,000, $350,000, it's going to be, most of those guys aren't going to see the mortgage interest they pay even be able to help them increase the standard deduction that they're going to get. So that's, if you got questions on that, let me know. So also for you, you're all small business owners, right? And you have sole proprietorship, or you may have an S corp or some other, or a partnership that you're running your business income through. Currently, you can deduct 20% of that qualified business income, right? The new law, you can still do that, but there are some changes. So that's going to start to, they're going to have some clauses in there that you're going to start to be able to deduct less, starting at $157,000 for a single filer and $315,000 of business income for if you're filing jointly. So you're going to start seeing less and less deductions the more income that you make. So something to watch out for and talk to your accountant about. Also, right now you can deduct moving expenses generally, right, when you move, even if you don't itemize. But in the new, with the new law, new tax code, you cannot, unless you're military, and even then it's by exception. So that's also a big change, and I'm sad to hear about that. And then we have a new inflation counter. So currently we track inflation, and tax brackets are based on CPI, the Consumer Price Index, but going forward, it's going to be off the chained Consumer Price Index. So think of it as a moving average. So like a trend line, since it's averaging, it goes and moves slower. Right, like in 2016, for example, the 33% tax bracket started at $190,150. In 2017, it went to $191,650. 2018, under the old tax code, it would expect it to be $193,500 or higher, but with this new tax code and the chained CPI, it may stay exactly where it is. So that means you may find yourself making more money and jumping into a higher tax bracket sooner and paying more taxes and getting less take-home pay. So that's how that affects you and everybody, really, especially when you're running a small business and have a sole proprietorship, again, a partnership, an S corp, something like that. Then the last thing, and I do want to end on a high note, is that currently you have $250,000 in you have $250,000 that you can exclude in capital gains on your primary residence, and $500,000 if you're filing jointly if you've been in your home 2 of the last 5 years. Going forward, what they wanted to do, House and Senate both submitted provisions that would change that to having to be in the home 5 out of the last 8 years, which would affect tens of thousands, hundreds of thousands of first-time homebuyers, because most of them are in their home 3.3 years. Luckily for us, that did not get through. Those provisions, neither of them prevailed, so that has stayed the same. So for the people that didn't sell their house this year, like, oh my gosh, I'm going to sell next year, and now I don't get to exclude this, they are fine. They'll be good as long as they've been in their house 2 out of the last 5 years. So I hope this helps you talk more with your buyers, understand the tax code better. If you've got questions, please let me know. We know there's some changes here. We want to be here to help. We appreciate your trust, and we look forward to making 2018 great regardless of what happens with the tax code and anything else. Thanks so much. Have a wonderful weekend and a Merry Christmas.